Hey everyone, and welcome to a deep dive
Deep dive.
into the world of buy and hold investing.
Yeah.
So we're going to be looking at some articles from U.S. Bank and the Motley Fool today,
Yes.
and just kind of getting into what is this whole buy and hold thing all about?
Absolutely.
Is it right for you?
Yep.
And by the end, maybe spark some ideas of some companies that you'd want to
Yeah.
own for a long time.
I love it.
Right.
It's so interesting
Yeah.
that both of the sources we're looking at today really emphasize
Okay.
the idea that time in the market beats
Right.
timing the market,
Interesting.
which means, staying invested over the long term
Right.
often leads to better results than trying to predict those perfect moments to buy or sell.
Right. So instead of jumping in and out, trying to
Yeah.
buy low, sell high,
Exactly.
buy and hold is about really just riding those waves
Yes.
and letting your investments grow over time.
Exactly. It's more of like a passive approach,
All right.
focused on the long game.
Yeah.
So I guess the question then becomes,
Yeah.
why would someone choose this over the excitement of constant trading?
Right.
And I think U.S. Bank gives us 6 compelling reasons.
Yeah. And the first one really caught my eye. It was this whole idea of growth despite fluctuations. They were pointing out that over the past 35 years,
Wow.
the stock market has seen positive returns in almost 8 out of 10 years.
Yeah.
That's a pretty good track record.
Yeah, it really is. And here's something to consider.
Okay.
Most of the market's gains, or losses for that matter,
Right.
occur in just a handful of days each year.
Oh, wow.
So, trying to perfectly time those days is nearly impossible, even for, seasoned professionals.
Yeah, so if we try to jump in and out,
Yes.
we could totally miss out on those crucial days
Yeah.
that are really boosting returns.
Definitely.
And U.S. Bank actually had a chart that kind of illustrated this.
Oh, cool.
It was showing the impact of missing,
Mm-hmm.
even just a few of the best days in the market.
Right.
They were looking at investing $10,000
Okay.
in the S&P 500 from 1990 to 2023.
Wow. Long time.
Yeah, and if you stayed invested that whole time, you'd end up with over $137,000.
Huge.
But miss just the 10 best days.
Oh.
And your returns would be slashed
No.
by more than half.
Really?
It'd only have about $68,000.
Wow. Talk about a missed opportunity.
Yeah, that's rough.
Yeah.
Ouch.
Ouch is right.
So that makes a pretty powerful case for staying invested.
Right.
And speaking of tough times,
Yes.
what about recovering from a bear market?
Right.
You know those periods where the market takes a dip?
Yeah.
Like we saw in 2008?
Yeah, exactly. And U.S. Bank tackles that too.
Okay.
Using a hypothetical scenario.
Okay.
Imagine you invested $1,000
Mhm.
in the S&P 500 on January 1st, 2008,
Oh, right before.
right before things went downhill.
Okay.
By the end of that year, your investment would have shrunk to $630.
Yikes, that's a pretty steep drop.
It is. It is.
Yeah, but they compared what would happen if you stayed invested with that $630 versus shifting it to a savings account.
Oh, okay. Interesting.
Yeah.
Okay.
That was earning a modest 3% interest.
Oh, okay. Got it.
And the difference is really striking.
Oh, really?
By sticking with your stocks,
Mm-hmm.
you would have covered your losses by 2012.
Okay.
But with that savings account, it would have taken 16 years just to get back to your original 1,000.
Wow. So even when the market throws a curveball,
Yeah.
buy and hold helps you bounce back faster
Wow.
than playing it overly safe.
So okay. I've always been intrigued by this concept of compound interest.
Oh, yeah. It's a powerful one.
Yeah, and U.S. Bank had an example that I thought really brought this to life.
Okay.
They were showing how $100,000 invested in the S&P 500
Okay.
over 30 years,
Mm-hmm.
ending in December 2023,
Oh, wow.
would have grown to over 1.8 million.
Yeah. It's like that snowball effect.
Right.
Your early gains generate even more gains over time.
Yeah, it's like this financial chain reaction.
Exactly.
But it's not just about price appreciation.
Right.
There's also the power of dividends.
Absolutely. Dividends, those are those lovely little payments companies make to their shareholders.
Right.
Essentially, they're sharing a portion of their profits.
Mm-hmm.
And I think what a lot of people overlook is the magic of
Yeah.
reinvesting those dividends.
Ooh, that's where it gets really exciting.
Yeah.
The U.S. Bank article mentioned that over long periods,
Mm-hmm.
dividend reinvestment could contribute a third to 40%
Wow.
of your total returns.
That's huge.
It's huge.
Yeah, and it's important to note
Okay.
that in a taxable account, those reinvested dividends can trigger taxes each year.
Okay.
But the potential for boosted growth is still remarkable.
Yeah.
Think of it like planting a seed.
That grows a fruit tree.
Right.
But then you plant the seeds from that fruit
Wow.
to grow even more trees.
That's a really good analogy.
Yeah.
And speaking of different approaches, U.S. Bank also briefly compared passive investing,
Yes.
which is our focus today, with active investing, which is where you're constantly buying and selling, trying to like beat the market. And I see you're saying that, active investing can be tempting.
It can.
But for a lot of investors,
Yeah.
that steady hands-off approach of passive investing actually leads to better returns over time.
Yes.
It's about trusting the process.
Absolutely.
And resisting the urge to like chase every market blip.
Exactly.
Makes sense. Okay. Before we move on to the Motley Fool's perspective,
Okay.
I want to touch on the U.S. Bank article's final point,
Okay.
which was this whole idea of faster loss recovery.
Oh, yeah.
They were arguing that like during the 2008 financial crisis,
Even though the stock market tanked initially, those who held onto their investments recovered a lot faster than those who shifted to low-yield options like savings accounts.
Precisely. And they even gave us some like data points.
Oh, perfect.
So if you imagine you invested $1,000 in the S&P 500 at the beginning of 2008, by year end, your investment would have plummeted to $630.
Ouch.
Ouch is right.
Yeah.
But if you held on to that $630 and rode out the storm, you would have recouped your losses and been back to your original investment amount by 2012.
Wow, that's a pretty quick turnaround.
It is.
What about the folks who got spooked and moved their money to a 3% interest savings account?
Well, they would have had to wait until 2024.
Oh my gosh.
A whole 16 years.
Wow.
Just to get back to their initial $1,000.
That's a stark reminder.
It is.
Of the potential downsides of trying to time the market.
Yeah, exactly.
Okay, so we've seen how buy and hold can help you grow despite fluctuations. Miss those crucial best days.
Right.
Recover faster from market dips.
Yeah.
Now let's shift gears to the Motley Fool's article.
Okay, sounds good.
Which tackles a broader question.
Yeah.
Why invest in stocks at all?
Right. Why stocks?
Right.
They make a really compelling case for stocks being a cornerstone of your portfolio, especially when it comes to potential for higher returns compared to, say, bonds.
Right.
Historically, the S&P 500 has returned between 8 and 12% annually.
Wow, that's significantly higher than typical bond returns.
It is.
Okay, but what about the elephant in the room?
Okay.
Inflation.
Right.
How do stocks fare against rising prices?
That's another area where stocks really shine.
Okay.
The long-term inflation rate in the U.S. has averaged about 3.1% annually since 1913.
Wow.
So while inflation erodes the purchasing power of your money, stocks have historically outpaced inflation.
Oh, wow.
Helping you preserve and grow your wealth over time.
So stocks offer the potential for higher returns and can act as a hedge against inflation.
Exactly.
Two pretty compelling reasons to consider them.
I agree.
And the Motley Fool doesn't stop there.
Oh.
They list a bunch of other perks.
Really?
Of stock ownership.
Okay.
One is the possibility of generating passive income.
Yes.
Through dividends.
Dividends. We love those.
I do.
Passive income.
Another is the pride of ownership.
Oh, interesting.
Right, like becoming a part owner of these companies whose products or services you believe in.
I like that.
Right.
Yeah.
Or companies that are making a positive impact on the world. I like that it adds a personal touch to investing.
It does.
And they also point out that stocks tend to be more liquid than, say, real estate.
Right.
Meaning you can sell them more easily if needed. And then they also highlight the accessibility of stock investing. It's not just for the wealthy anymore.
Yeah.
With fractional shares and zero commission trading. It's easier than ever to start building a portfolio, even with a small amount of money.
I love that.
So we've got higher return potential, inflation protection, passive income possibilities, pride of ownership, liquidity, and accessibility.
That's a pretty convincing case for stocks.
It is. But like any investment, it's essential to understand the risks.
Of course.
And that's what we're going to delve into next.
Can't wait.
Welcome back, everyone.
Welcome back.
So far, we've explored why buy and hold investing
Right.
It's all about time at the market.
Right.
Not timing it.
Yes.
And we've uncovered some pretty compelling reasons why stocks deserve a spot in your portfolio.
I agree.
But before we dive into the potential risks,
Okay.
I kind of want to address a misconception. I think some people hear buy and hold, and they think it means you just pick stocks and, like, forget about them completely.
Yeah, like bury a treasure chest.
Yeah.
Well, that magically multiplies.
No, like it's a totally hands-off, set it and forget it strategy.
Exactly.
But I have a feeling it's not that simple.
You're right. It's not about complete neglect.
Okay.
So while buy and hold IS, less active than, say, day trading,
Right.
or, constantly chasing hot stock tips, it doesn't mean you completely ignore your investments.
So it's more like tending a garden.
I like that analogy.
You carefully choose what to plant.
Right.
But you still need to water weed and make sure everything's getting enough sunlight.
Yes.
So how often should we be, like, checking in
Yeah, that's a great question.
on our buy and hold portfolio?
And I think the answer kind of depends on your personal preferences and risk tolerance.
Okay.
Some investors prefer a quarterly review, while others might do it annually.
Right.
The key is finding that balance between staying informed and avoiding those, like, knee-jerk reactions to short-term market noise.
Right. We're playing the long game here.
Exactly. We are in it for the long haul.
Okay, let's talk about those risks.
Okay.
The Motley Fool article touched on volatility.
Yes.
Those ups and downs of stock prices and time horizon, like the fact that stocks are best suited for long-term goals.
Right.
What other potential downsides should we consider?
Well, I think it's important to acknowledge that both of the articles we're looking at today kind of assume the stock market will continue its historical upward trend.
Right.
But as we all know, past performance doesn't guarantee future results.
Right. No one has a crystal ball.
Exactly.
And while the market has always recovered from past downturns, there's no guarantee it'll always do so in the future.
That is true, and that's why I think diversification is so crucial.
Diversification.
Yeah.
We hear this word all the time in the investing world.
All the time.
But can we, like, break it down?
Yeah.
What does it really mean?
Yeah.
And why is it so important for managing risk?
Absolutely. So in simple terms, diversification is about not putting all your eggs in one basket.
Okay.
It means spreading your investments across different asset classes like stocks, bonds, real estate, and even some more specialized areas like commodities or precious metals.
So instead of putting all my money into, say, tech stocks, I might also invest in healthcare consumer goods, other industries.
And you can even diversify further within each asset class.
Cool.
So, for example, instead of betting on a single tech company, you might invest in a tech-focused mutual fund or ETF that holds shares of many different companies in that sector.
So the goal is to create a portfolio that can kind of weather market storms.
Exactly.
And reduce your overall risk.
It's like having a backup generator in case the power goes out.
I like that.
You've got multiple sources of energy to keep things running smoothly.
Okay, so diversification helps kind of mitigate some of the risks associated with buy and hold. Are there any other potential downsides?
Well, one potential drawback is that buy and hold does require a significant amount of patience and discipline.
Yeah.
It's not a get-rich-quick scheme.
Right.
It's a long-term strategy that requires you to stay committed even when the market is throwing tantrums.
It makes sense in today's world of, like, instant gratification.
Right.
Patience can be a rare commodity.
It really can.
But it sounds like that's precisely what makes buy and hold so powerful.
I think so.
It forces you to think long-term, avoid the temptation to chase those short-term gains.
Right. Slow and steady wins the race.
It's about playing the slow and steady game.
Exactly. And like any marathon runner will tell you, success requires endurance, perseverance, and a clear focus on that finish line.
Okay, so we've talked about the need for patience and the importance of diversification.
Yes.
But there's another piece of the puzzle we haven't really touched on yet.
Okay.
And that's taxes.
Yes, taxes.
How do they factor into all of this?
Especially with a long-term strategy like buy and hold?
That's a great question. And, taxes can have a significant impact on your investment returns.
Okay.
Especially with a long-term approach.
Right.
Because the longer you hold an investment, the more potential there is for taxable events.
Right.
Like capital gains, which is the profit you make when you sell an investment for more than you paid for it.
Okay.
Or dividend income.
And I imagine the tax implications can vary depending on what kind of account we're using.
Absolutely.
Like a traditional brokerage account.
Right.
Versus a retirement account like a 401k or IRA.
Exactly. And understanding those tax implications of your investments is crucial for maximizing those after-tax returns.
Okay.
We could easily dedicate a whole other deep dive to just this topic.
Oh, yeah, we could.
But I think for now, it's enough to know that it's something to keep in mind as you're kind of exploring different investment options and strategies. Absolutely. And it's always a good idea to consult with a financial advisor.
Of course.
Or a tax professional.
Yes.
To get that personalized advice on how to manage your investments in a tax-efficient way.
For sure.
Now, listener thing. The Motley Fool article mentioned really caught my eye.
Okay. What's that?
It was this concept of the pride of ownership.
Oh, yeah.
It's not something you typically hear discussed.
You don't?
In the context of investing.
No, not really.
Like most conversations about investing focus solely on like the financial aspects, the returns.
The risks.
The numbers on a spreadsheet.
Yeah, the quantitative stuff.
But the Motley Fool brought up this like emotional element of owning a piece of a company.
Yeah.
So it's not just about watching your money grow.
Right.
There's like a deeper connection there.
And I think for some investors there is.
Okay.
There's a real sense of satisfaction that comes from owning shares of companies whose products or services they use and enjoy. Right. Or, you know, companies that are making a positive difference in the world.
It's like being a cheerleader for those companies.
I love that.
You're not just a passive observer. You're a part owner, rooting for their success.
And that emotional connection can be a powerful motivator, especially during those inevitable market downturns.
Right.
You know, it can help you stay the course and resist the urge to make those impulsive decisions based on fear or panic.
Yeah, I never thought about it that way. But it makes a lot of sense.
Yeah.
It adds like a whole new dimension to this idea of long-term investing.
It does.
Okay, so let's recap what we've covered so far in this deep dive.
Okay.
We've explored the core principles of buy and hold investing, uncovered the potential benefits and risks, even touched on the importance of diversification and tax considerations.
Right.
But there's still one crucial piece of the puzzle we need to explore.
Ooh, I'm intrigued.
And that's how to actually choose the right companies for a buy and hold portfolio.
Right, like what factors should we consider?
What research should we do?
What red flags should we watch out for?
Those are great questions.
Big questions.
And I'm eager to learn more.
Me too.
Welcome back to the final part of our deep dive.
The final part.
Into buy and hold investing.
Yes.
We've covered a lot of ground, you know, from understanding those core principles to exploring the benefits and risks.
Yeah.
We've even touched on the importance of diversification and taxes.
Big ones.
But now comes the exciting part.
Yes.
Putting all of that knowledge into action.
Yeah.
Figuring out how to actually choose the companies that will form the foundation of your long-term portfolio.
I love it. It's like we've assembled all the ingredients.
Right.
And now we're ready to like bake the cake.
Yeah, a delicious cake.
A delicious cake.
Made of carefully selected stocks.
Exactly.
So where do we even begin?
Right.
When it comes to picking the right companies for buy and hold?
Well, both the U.S. Bank and the Motley Fool really emphasize, you know, finding great companies.
Right. But what does great actually mean in this context?
Yeah. It's not just about picking names we recognize or chasing the latest trends.
Right. We're looking for companies with like solid fundamentals.
Solid fundamentals.
And a track record of sustainable growth that can withstand those inevitable market ups and downs.
Exactly. Because remember, buy and hold is about the long game.
It is the long game.
We're not looking for quick flips or short-term gains.
No.
We're seeking companies that have that staying power.
Right.
You know, the ability to kind of weather the storms and come out stronger on the other side.
Okay. Solid fundamentals.
Yes.
Sounds like a good starting point.
It is.
But can we break that down a little bit further?
Yeah.
What specific factors should we be looking at when assessing a company's strength?
Well, one of the first things I always look at is their financial health.
Okay.
Are they consistently profitable? Do they have manageable debt levels?
Right.
Are their revenues growing steadily?
So it's not just about looking at the stock price.
No.
It's about understanding the underlying business.
Yes.
And how well it's actually performing.
Exactly. We want to invest in companies that are well-managed, financially sound, and have a clear path to future profitability.
Okay.
Think of it like building a house.
Okay.
You wouldn't want to build it on a shaky foundation, right?
Right.
You need a strong base to withstand the storms.
That makes perfect sense.
Yeah.
Financial health is crucial.
It is.
What else should we be considering?
Another key factor is the company's competitive advantage.
Okay.
What sets them apart from the crowd and helps them stay ahead of the game?
Yeah.
Do they have a unique product or service? That's hard to replicate.
Okay.
A strong brand reputation that customers trust.
Right.
A loyal customer base that keeps coming back for more.
So we're looking for what investors often call like a moat.
A moat, exactly.
That protects a company from competition and helps them maintain their market share.
Precisely, a company with a wide moat is more likely to withstand those challenges, adapt to changes in the market, and continue to grow over the long term.
Can you give us like an example?
Yeah, so think of companies like Apple.
Okay.
You know, known for its brand loyalty and ecosystem of products, or Amazon with its massive logistics network and customer-centric approach. These are examples of companies with strong moats that have helped them achieve remarkable success.
Okay. I'm starting to get the importance of a moat.
Yes, moats are important.
So we've got financial health, competitive advantage as our key pillars. Anything else we should be factoring in?
There's one more crucial element, I think, and that's the company's industry.
Okay.
And its overall growth potential. Is the company operating in a sector that's likely to expand in the future?
Right.
Are there trends or tailwinds that could propel their growth?
So even if a company is financially healthy, has a competitive advantage, we need to zoom out.
Yes.
Look at the bigger picture.
The bigger picture.
Of the economic landscape.
Exactly.
That they operate in.
Think of it this way.
Okay.
Investing in a buggy whip manufacturer in the early 1900s might not have been the best long-term strategy, even if they had the best whips in the world.
Right.
You know, the rise of the automobile disrupted the entire industry, and companies that failed to adapt were left behind.
That's a great analogy.
Yeah.
It really drives home the point about understanding industry dynamics, anticipating potential disruptions.
Yes, very important.
But let's be realistic here.
Okay.
Even with like careful research and due diligence, no investment is entirely risk-free.
True.
Even the most promising companies can stumble.
They can.
Or face unexpected challenges.
Right.
So how do we assess the potential downsides of a company?
Yeah.
What red flags should we be watching out for?
Well, one thing I always carefully evaluate is management quality.
Okay.
Are the leaders experienced, trustworthy, aligned with the company's long-term vision?
Right.
Do they have a track record of making sound decisions, navigating challenges effectively, treating shareholders fairly?
It sounds like strong leadership can really make or break a company's success.
It really can, especially over the long haul.
Especially over the long haul. Okay, what about red flags?
Another red flag to watch out for is excessive debt.
Quick.
If a company is saddled with a mountain of debt, it can limit their flexibility, hamper their ability to invest in growth, and make them more vulnerable to economic downturns.
It's like trying to run a race with a heavy backpack on.
Exactly.
Close you down.
Makes it harder to reach the finish line.
Okay, so management quality, debt levels.
Yes.
2 key areas to scrutinize. Anything else?
Even if you found a company with solid financials, a competitive moat, strong leadership, you still need to consider their valuation. Are their shares priced fairly relative to their earnings and growth prospects?
Makes sense.
Because even a fantastic company can be a bad investment if you pay too much for its stock.
It's like going to a farmer's market.
Yes.
Falling in love with the most beautiful, juicy strawberries. But then finding out they're being sold for 10 times the price of all the other berries.
Exactly. Suddenly they don't seem quite as appealing.
Not as appealing.
Yeah. Value is always an important consideration.
It is.
When making investment decisions.
Okay.
Remember, we're not just looking for good companies. We're looking for good investments.
Okay. That's a lot to consider.
It is a lot.
But thankfully, we don't have to navigate this whole research process alone.
We don't. We don't.
What resources can help us gather information about companies?
Yeah.
Make more informed decisions.
Well, for starters, both U.S. Bank and The Motley Fool have a wealth of information on their websites.
Okay.
Including articles, research reports, even educational courses on investing.
And there's also independent financial research firms.
Yes.
Like Morningstar and S&P Global that provide in-depth analysis of companies and industries.
They do.
Often with detailed financial data, industry trends, analyst ratings.
That's a lot of information out there.
And don't underestimate the power of the SEC's EDGR database.
Oh, yes, the EDGR database.
It's like a treasure trove of information.
It is.
You can access company filings directly, including financial statements, management discussions, other important disclosures.
It's like getting a behind-the-scenes look at how a company operates.
And, of course, there's good old-fashioned reading.
Yes, reading is fundamental.
Books, reputable financial news sources, even industry publications can provide valuable insights and perspectives.
Absolutely. It's all about arming yourself with knowledge. Becoming a more informed investor. And feeling confident in your choices.
I love that.
Yeah.
Well, this has been an incredibly insightful deep dive.
It has.
We've explored the what, the why, the how of buy and hold investing.
Yeah.
From understanding its core principles to identifying the right companies, managing risks effectively.
And most importantly, we've equipped you with the knowledge and resources to start building your own buy and hold portfolio. With confidence and purpose.
So as we wrap up this deep dive,
I
want to leave you with a final thought.
Okay.
Buy and hold isn't just a strategy. It's a mindset.
It's a mindset.
It's about thinking long-term.
Yes.
Embracing patience. Believing in the power of compound growth.
And it's about finding companies you truly believe in.
Yes.
Companies that are building a better future.
Yes.
And becoming a part of their journey.
Happy investing, everyone.
Happy investing.